Howdy there, folks, and welcome into today's video. It's a buy one, get two free. 3 videos for me to react to in this one here today. This first one, oh my gosh, is this an interesting one to react to? I think the markets are going to slowly erode for 2 years. 2 flipping flapjacking years? That might be the scariest thing you ever heard, or it might be the most exciting thing, depending upon your investment time horizon. Okay, so we'll react to that one. I'll give my opinion on that video. I think it's an important one. Next one up here we'll react to is markets need to prepare for, quote, an incomplete hard landing, says a gentleman from Harvard. So we'll react to that one, give my opinion there. And then Josh Brown says if we can just get through this week, we're going to rip into the end of the year. And I have a pretty strong opinion on that one from Mr. Josh Brown. So yeah, 3 videos to react to. Hope you guys enjoy this. As always, I appreciate everybody that always joins me for these reactions, which now we're at like 19,700 plus subscribers on this channel. So thank you every single person that subscribed to the channel. I appreciate you guys in a massive, massive way. If you're looking to access all my courses, as well as the private Discord chat, the exclusive Discord chat, exclusive videos from me, exclusive content, as well as so much more, check out the pinned comment down there. We also have all a la carte options if you're looking to just get access to our full Discord chat and exclusive videos, or just the course curriculums. And we even have smaller options for some folks that are interested in that, including a lot of folks joined this past week for the Tesla squad, and a lot of folks this past week joined for the Palantir squad. So welcome all the new folks that joined in there. So if you want access to that, that will be pinned comment down there. Alrighty, guys, let's get into this.
Good to have you back, AP.
Yeah, thanks.
Welcome.
Yeah, thanks for having me.
So we're in this period. What is good news? What is bad news right now?
You know, it's like we need the old Goldilocks, right? You know, we don't want if it's too good, then people will say, wow, they're going to stay hawkish for a long time. And if it's really bad, people will get nervous that the bear case on earnings could form. So we're back in that we need Goldilocks mode. And look, we know that a lot of what moves the markets is perception about policy and perception about rates. It seems like the data, we get some big data points next week, right? And so I think that could cause, I think today's the first I would call low vol day we've had in a while. S&P, basically flat. So feels like people are waiting for some Fed commentary for the CPI and some other stuff next week to get some capital moving around.
We got Bank of Canada this morning signaling a potential pause in their upcoming meetings. Does this get easier once the Fed does pause and we can worry about the work that's already been done versus how much more they would add?
I think you guys saw in our note, there's like 5 or 6 things that are just competing forces. It's like we're tied at 0 because there's 3 positives and 3 negatives, right? We've got, I think, a much higher probability the economy is slowing than it's getting better. I think that's pretty obvious. But we've got incredibly low sentiment. We see it when we get a 7.7% CPI and stocks are up 2 years of returns in 15 minutes, right? So we know there's some power to get behind things if we can believe in the soft landing, if we can believe the consumer's robust. I'm really not in that camp. I think we're going to continue to slowly erode as we talked about a couple times.
You've mentioned this a number of times. You actually think 20...
Whoa. Okay, before we get into that, I think an important point he makes there is this is my personal opinion, okay? I believe that the case around the soft landing has evaporated, okay? I'm even starting to, not believe in the whole soft landing thing at this point. It's more like, are we going to have a let's call it harder landing, or are we going to have a crash landing? That's I think the main subject now at this point. And I believe that is most of Wall Street slowly starting to go to that side of like this whole soft landing scenario seems a little far-fetched. And I think if we get into the springtime especially, and the economy continues to weaken more, companies' earnings continue to weaken more, that's when there's going to be no one believing anymore at that point in time that we're having a soft landing, and every single person will be over to the hard landing or crash landing, depending upon how you want to look at it. So, I definitely think that's become kind of the consensus now at this point in time. But eroding for 2 years, what we got going on here, holy smokes.
324 is not going to be some
flattish,
great big growth. So you haven't changed. That view hasn't changed in the last few weeks or anything you've seen in the data.
I think that's still my base case because I just don't see this the V shape that we've all gotten used to in aggregate. We've gotten used to there's a collapse and then we get a bunch of fiscal and monetary stimulus and we get a V recovery. I don't see us on a V recovery path. I think we're, I think.
Why not though? Explain it again.
Because I don't think the Fed's hoping that they're going to end up, cutting next year. I know that's what's in the price. It's in next November it gets above 50%. But why would they be raising rates aggressively now to cut them next year? I think they're hoping that they could do it to the point to slow things down and not have to end up, providing stimulus within a 6-month period when you just did a humongous reduction. So
I think something very important is it doesn't matter what the Fed's hoping for. What matters is what happens. What matters is the results. What matters is what literally happens with CPI over this next 6 to 12 months. What matters is what happens to the unemployment rate over this next 6 to 12 months, because we know the Fed is obsessed about two things, and they've been obsessed about two things for basically all of eternity: inflation and unemployment. And they talk about that over and over again. Everything else doesn't even matter to the Fed. All they really look at is inflation and unemployment rate. That's all they care about. And everything else is just like, if unemployment's in a place, let's just call it low, they're happy. They're content. They're going to feel no need to start cutting rates. Once unemployment starts to tick up and you go to 4.5% and then 5%, that's the moment that the Fed starts saying, uh-oh, cut. And that's when they start cutting, right? But the question is, will that be too late at that point in time? Because then you go from 5 to 7 and 7 and 9 and 9 to 11, because we saw that in the great financial crisis. And you saw how fast it played out. And so the question is, does something similar happen in this scenario? And it's definitely a possibility, because the Fed lagged on the other side. Like I've spoken about many times, they can definitely lag on this side as well.
We'll see if they're that good, but I don't think that's the base case that they start cutting next year in my mind.
Yeah, of course, the implication of that being that maybe they've broken something if they start cutting, right? Like, that's the concern there, potentially.
Yeah.
But longtime market participants will say that there tends to be three legs to a bear market. Are we there yet? Are we in the third leg, or does something more to that point need to break?
I think that the top-down folks are getting too negative about earnings. I think, when people say 190 to 200, that feels like when you get a bit of a clearing in there. I think that's way too negative. I think the S&P 500 have some superior attributes and ability to protect margins that probably 220 or 215 is a more reasonable estimate. I think we're out with 218. So if you get 190, that becomes what people think. The market can have another big leg lower. I think that's reasonable. I don't think that's what's going to happen, though. I think you'll see... Look, next year, probably auto SAR will be up even though the economy's slowing. You can't show historically that ever happened. So there's some things that will offset as we still get, I don't know if the pig through the snake's the right analogy, we still get stuff happening through COVID, that you're just getting some anomalies still occurring. So I don't think earnings are going to collapse in aggregate for the S&P, and I think that's a positive. Sentiment's clearly low. I've got micro cap and small cap stocks trading basically at all-time lows on price to forward earnings. So I could see more and more private companies saying public equities look cheap to me. This started about a month, 6 weeks ago, when you saw Blackstone do that Emerson deal. It was a little bit of me of a watershed of like, wait a minute, these guys think public things are cheaper than private. And now I've got microcaps trading at 6 times forward, small caps at 10, 11 times forward. So I think you could see that as a positive vibe when you get more deals and people feel like there's a floor valuation in there for some of these names.
Yeah, no doubt. I mean, there's a lot of great deals in the market, assuming these earnings hold up. That's the key, right? Now, in terms of this whole belief about the market slowly erodes for the next 2 years being a possibility and no V-shaped recovery or something like that, I think it really depends upon how bad the economy gets. If the economy just slowly continues to weaken throughout 2023 and then just slowly kind of continues to weaken throughout 2024, then I can kind of see that scenario. But if the economy really starts to fall off the rails in 2023, which is a real potential as the year kind of goes on and it just starts getting ugly, pretty quick after the kind of the springtime, right? If that's the scenario that plays out, then the Fed will have to start cutting rates, and next thing you know, they'll have to start quantitative easing in the back half of 23 and maybe even at the beginning of 2024, which would obviously send us more into a V recovery, because then next thing you know, they're full go behind the market at that point in time. So it's really going to be dependent upon how strong the economy stays or how much more it weakens from here. That's this whole game, okay? And I think we're going to get a lot of clarity in the first quarter and in the second quarter especially, okay? Next video up here. Markets need to prepare for an incomplete hard landing. Becky Quick.
Joining us is Jason Furman. Of course, he was the chairman of the White House Council of Economic Advisors under President Obama. He's now an economics professor at Harvard's Kennedy School of Government. And Jason, before we get to what the Fed's going to do, I want to back it up a little bit. I've been thinking an awful lot about inflation yesterday and today. Just everybody's blaming everybody else for it. You can say it's because of wages going up, that it's now really embedded into the economy and it's going to be hard to get rid of. We had a labor leader on earlier this morning who said it's big corporations' fault because they keep raising prices. But really, you got to go back to Milton Friedman. He says it's Washington. Inflation always originates and comes from Washington. And we spent trillions of dollars during COVID, and the Fed left rates low for a very long time. What else did we think was going to happen?
Yeah, I certainly agree with that diagnosis. And you always try to tell individual stories around inflation. But what inflation is upward pressure on everything. You see it on prices, you see it on wages. And when it comes to the private economy, by the way, it's
But you don't see it on stocks, huh?
a morality play. If a business has a lot of customers that show up, they're going to raise their prices. If businesses really want to hire workers, workers are going to, increase their wages. That's just the way the economy functions. And then you have to ask, why is it doing that? Ultimately, it's really the government and ultimately the Fed's responsibility.
So it's too much demand for
in terms of the whole, why do we have such high inflation, right? Like, what happened there? I'll tell you exactly what happened there. One is we had a very strong economy going into Rona. 2020 should have been a pretty good year for the economy. Should have been a pretty good year for stocks overall. Corporate earnings were pretty optimistic. It should have been a good year, okay? Then obviously you had Rona. The government decides to shut down the world. All governments around the world, right? And next thing you know, you have just a crazy stimulus on so many different fronts, from the government side, from the Fed side, everybody, right? And it creates this just like ridiculous short-term demand when you already had a strong economy going into that. Then you had huge pockets of the economy just shut down, which means money couldn't have went into those spaces, like travel, for instance, is a great example, right? Events, all that sort of stuff. So then it goes into all these other random places because people are going to spend money. It doesn't matter if it's it's in the United States of America and around the world, people are going to spend money. And so you had this crazy pent up demand, and you saw it with Amazon numbers and almost every other company that sold products, right? And services as well. And it gave this kind of false illusion of demand in the economy and numbers and all those sorts of things, right? Then you add on the supply chain problems that ended up creating and various things from there. But that was the key. If we had went into Rona in a very weak economy with rather high unemployment, pumping all that money out there might have been okay, and we might have ended up with just things being kind of normalized. But when you go in with a very strong economy, very low unemployment, and then you say you can't even spend over here, but we're going to pump this massive flood of money, yeah, you can see why we had ridiculous inflation, right?
Little supply. I mean, the other question people keep asking is it different this time than it was in the 1970s? Is it different because we have all kinds of issues like a shortage of labor? We don't have the right immigration policies here. We have all kinds of problems with the supply chain. Can it be fixed this time with the Fed's tools?
It's always a little bit different, but it's pretty dangerous to go out there and say, we've seen something happen 6 times before in a certain way. For example, you can't bring inflation down without unemployment up. You can't see job openings and quits come down without unemployment going up. We've never, ever, ever seen that before, but we're about to see it this time. I do think anything's possible. I think a soft landing is possible. I agree with that. I just don't think it's the most probable outcome for next year. And, there's only so far your excuses take you. A year and a half ago, the economy was really scrambled by the pandemic. Now the labor market, as Chair Powell said at Brookings, it sort of is where it is. Maybe it's the fault of lack of immigration. We're not going to get a lot of immigrants in the next year. I wish we would, but we're not going to. So they have to go to war with the economy that they have, not the economy they wish they had.
So you think the Fed is only going to raise by 50 basis points, but you...
It was a weird subject to throw in there, Mr. Harvard.
It's going to be a hawkish 50 basis points, I guess, because of what they're going to say around it?
Exactly. I mean, look at, they did 75 in July, and that was a dovish 75. The market experienced relief up until Jay Powell dashed it at Jackson Hole. We've seen a big easing of financial conditions. I think some of that is warranted. Some of the data that's come in, like the productivity numbers yesterday, were a little bit optimistic in terms of unit labor cost growth being lower. Some of the other data that's come in has been really pessimistic. The large upward revisions to wage growth in September and October, for me, were sort of an aha moment that made me much more worried. So I think the Fed is probably nervous about how easy financial conditions have gotten. In a sense, there's been a 50 basis point easing since October. And I don't think they're going to want to see more of that. So they say do 50 at this meeting, but leave on the table, a string of 50s after this, if that's necessary.
And I guess the bigger question is, what's the terminal rate? Is 5% the number? Is it going to be higher than that?
Look, if I had to do my best guess, I would say 5 or 5.25. But where I, sometimes worry is I think a number over 6 is completely conceivable. If we're seeing inflation, in the 4s next year, they're going to keep going. Maybe it's even just 25 basis points a meeting. That'll take them above 6. That's not my best guess, but markets really need to be prepared for that. The other thing markets need to be prepared for is it may not be once and done. We may have an incomplete hard landing where we have a bit of a recession. We have inflation come down, but it comes down to something like 3.5. And then the Fed needs to sort of do another tightening cycle to get that inflation down further.
Yeah, I mean, certainly a possibility, but I mean, if he mentioned there about, let's say inflation comes down to the 4s, Fed at 6 or something like that. I mean, they could do that certainly, but that's not usually, something the Fed would usually want to do. They want, if anything, they'd want to kind of have Fed funds rate be something somewhat around where the inflation rate is, right? And not in a position where it's considerably higher. Like that would be 200 basis points higher. Everything's a possibility, obviously, but I don't know how realistic that is, okay? Josh Brown and his opinion on this market shooting higher. Okay, Mr. Josh Brown, let's hear it. Okay, no, I'll wait.
Moment, this current rebound, let's call it, at its best moment, this current rebound, let's call it, we had, I would say it's November 30th. And there might be some month-end stuff involved here, but we saw 64% of the S&P 500's components back above a 200-day moving average. And granted, many of these moving averages are downward sloping, but still, you had about 2/3 of the S&P back in some semblance of a bull market. And that looked pretty good, and we've backed off of that a bit somewhat in the last 10 days. But if we can challenge that level in the internals, while at the same time holding above that 4,000 level, psychologically important 4,000 level in the S&P, and the three biggies next week, retail sales Thursday, the day before that FOMC, and the day before that CPI. Like if we can just get through those and we get that kind of bread thrust in the internals, we could rip into the end of the year. And I'm going to tell you, Mike, you and I, we could sit for an hour back and forth.
Right when he said we could rip into the end of the year, did you hear that in the background? People went mad. Holy smokes.
Negatives. They're very well known. The AAII survey has had 36 weeks in a row where more people responded bearishly than bullishly. That is a longer count by weeks.
Who was that? The Kevin crowd in the background? What's going on there, man?
Then COVID, which was 34 weeks, and the great financial crisis, which was 15 weeks. 36 weeks of outright bearishness. We all get it. We all get it. But if we can clear through these three big bad announcements next week and the breadth is there, what are you going to say? It's going to be really hard to say anything much other than, all right, I better buy some more stuff. And look, it's seasonally, that's on your side. It's not easy to do if you're worried about earnings and inflation and all these things, but that's what the market is telling me.
Yeah, I mean, the massive, colossal issue is now everybody's begun to believe the Fed's only going to do 50 basis points. When if, there's a big if, but if CPI comes in hot, they're probably going another 75 basis points. So the Fed, I feel like the Fed's kind of 50-50. They're really waiting for CPI and to see what number that comes in at and to kind of make their move there. And so, I think if it comes in hot after PPI just came in hot, right? I think it's very possible they could, at that moment, go 75 basis points. Now, if they go, and obviously that would be devastating to the market. And if they go 50 basis points, everybody's already kind of expecting that. So this whole year-end rally, I understand Wall Street wants to get their bonuses. They really do, okay? Because it's been a tight year on Wall Street. Hasn't been a lot of bonuses to go around, right? But at the end of the day, it's just even myself as a bull, I'm kind of looking at it, I'm like, it's a possibility, but it will only, if the market rallies after the whole Fed meeting and announcement and whatnot, it'll only be because Wall Street's trying to get those bonuses. And that will be it. It'll have nothing to do with anything else at that point in time, just to be clear about that. So if you see markets rallying, just understand what it is.
And you're saying if, and I realize you have to say if, because obviously there's no way to handicap it ahead of time. And these things can, even if it's a 60-40 bet that it's going to be for the better, you can't necessarily be that confident about it. But to your point about expectations, I mean, whatever this market's issues, excessive optimism is not one of them, right? I mean, you see strategists projecting in aggregate consensus.
I knew it was the Kevin crowd in the background that was making all that noise. See the PP on the, yeah, I knew it was them.
Next year for no upside to the market, and virtually everybody says down first, then up if we go flat. I guess that's a help. And how about the other stuff we're worried about? Wage growth too high. And it's a very tricky moment when we're talking about, we're now worried about risks to growth, but on the other hand, the economy hasn't slowed down enough yet.
You know what's funny? We really didn't fall apart after that strong employment report. It wasn't it wasn't showing any kind of abatement in inflation. It was just showing resilience. And that didn't kill stocks. So I don't know that we're outright rooting for a crashing economy and that sort of thing automatically puts a bid in for equities. I'm not so sure. But look, the TD Ameritrade keeps this thing called the Investor Movement Index. That is at its lowest sentiment since April 2020. Do you know what the nation's mood was in April 2020? The types of things we were contemplating? Millions of people about to die? Kids out of school? That is where sentiment is. So it's not going to take much. The put-to-call ratio this week hit a century high. So yes, I get it. All the negatives and high wages. All right, I understand. Who doesn't know about these things? So that, to me, that's where the setup is. And I'm trying for the first time this year to be in the bull camp. I'm struggling, but it's getting easier because nobody else seems to want to.
Right. Well, it is tough because I can think back to these relentless bull market years where you say to yourself, well, can it be that easy to just buy every 5% dip? Can it be that easy to just bid for every 20-day low in the S&P? You know what I mean? You know how it is.
It was.
So in other words, these trends can trend. Right. So I guess the point is, in practical terms.
The question is, what's different this time? What's different this time? That's what he should ask, right? And the thing that's different this time is there's true, real fears about the economy, as there should be. And the reason being is you're hearing company after company after company missing numbers, barely hitting numbers, super low growth rates, if any growth rates. And ultimately, what we're seeing out there is the Fed's not coming to the rescue anytime soon. There will be a point in time when the Fed has to come to the rescue, but it's not right now. And it's not for at least the next maybe 6 months or so, right? After that, it depends on how fast things deteriorate and from there. And so there's real concerns about the state of the economy and what's going to happen in 23. And I understand it, and there should be, right? And so that, I think, is the one thing that's different now versus in the past where it was just buy and we're going back up. And why, 2023 could be a very shaky year for the markets overall because of that, okay? And that's obviously something I spoke about in my very in-depth video on the main channel I put out last weekend around 2023 and kind of my thoughts on 2023 in the market. If you didn't get to check out that video, definitely check that out. It's a well-done video that I put, quite a bit of time into, so definitely want to check that one out.
Or in tactical terms, what specifically would you be looking to do just to sort of make sure that you don't have too little exposure to the market or look for stuff that the market has already punished or how to play it?
Well, on a tactical level, some of our index bets triggered long at the end of November. So those are on various time frames, and we don't look at daily we don't look at weekly. We're looking at monthly moving averages and closes below, above. We're looking at slope. So we are longer now than we've been since April. And that may not last. This is rules-based. It's technical. We'll see what happens. But those are straight-up index bets. It would really be a shame to get constructive or bullish on the market and then buy the wrong stock, like put a bet on a Meta or something that goes against you in a rising tide. Like even look at Tesla, which is a really big, important stock now, versus this recent market recovery. It's going in the wrong direction. So I think if you want to start to get more constructive here ahead of these big bad reports, maybe the right answer is to just not get too cute.
Yeah, but the same thing I would say, Josh Brown. Why do you think Tesla's been going down? Why is that happening? It's not just the whole Elon Musk and the Twitter saga. Let's call it that. That's definitely a component of it, but that's not the main reason. The main reason is, as time's ticking on, there's more and more serious, real concerns about the economy, what's going to happen in the credit markets over this next year, and what that means for a company like a Tesla that sells, let's say, $50,000+ vehicles for the most part, right? And so, I think that's just kind of some food for thought, and I think that's why a lot of folks are a little more on the timid side to deploy capital out there right now, because they want clarity around the economy and they feel like they can't get it right now, okay? So, yeah, that's my thoughts on that. Hope you guys enjoyed today's video. Thank you, everybody that subscribed to the channel, 19,700+ subscribers. Appreciate each and every one of you that subbed to this channel, and a lot more videos coming for you in the future. Much love, and have a great day.